Hello, everyone. John Hutchinson with Traders Reserve, along with Dave Durham, my partner. Thank you and welcome to the 5K Income Challenge webinar. Today, we're going to be talking about an unusual and aggressive approach to average $5,000 per week net income, selling options while trading a $100,000 portfolio. This is an endeavor that we started last year, a year ago, November. So we're now into our second year of the 5K income concept. And today I'm going to walk you through a bit more in depth some of the experience that we've had and some of the secrets that we've discovered that we wanted to reveal to you, to show you new or alternate ways to think about how to use options in your trading and how to attack the markets. Even though they have been unstable, they are becoming more stable, but to attack those markets for higher profits. Behind the 5K Income Challenge are Dave Durham and Chris Davis. Chris Davis has been trading with us since 2020. He's the one who brought this idea to us. And he and Dave have put together a tremendous program. And that program essentially provides the trading background behind the 5K Income Challenge. And I'll give you a little bit of the genesis on this in a little bit. But the big idea here that Chris brought to us was, that I want to prove that I can make 5K per week. And we said, okay, let's do that. So the ideas, the tactics, the approaches that we're sharing with you here today come from this idea that he had. And a little bit of a note on Chris. He had been trading with us in various services. He has a long background as an options trader, but he had been trading what we do much more aggressively, and he had been getting results. So he shared with us what he was doing, and that sort of became the basis for how we arrived at not only the 5K Income Challenge, but also our Small Account Trader Pros service. In the background of what he brought to us and what we have discovered together over the last year and a half trading with him is this idea of factors affecting the potential and profitability for options traders that go beyond the technicals, the Greeks, etc. These are more fundamental probability to financial, if you will, factors. And I want to take a moment to talk about a couple of these because the way that I'm sharing some of this information with you today will sort of show you where what you may be doing now can have more advantage to you with some minor changes. Whether or not you're a part of the 5K Income Challenge does not necessarily have to make that so. The number one and number two kind of go hand in hand, and that's scale and leverage. When people talk about leverage, they typically talk about leveraging capital. And I would like to change that a little bit to leveraging tactics. And what I mean by that is it's the tactic that allows you to leverage capital in a different way. And that different way is done through scale, meaning instead of selling a single contract on a single-sided put contract on X amount of capital, there are ways, tactics that you can use that allow you to scale that to 2, 5, 10, 20 contracts while keeping a somewhat of a one-to-one relationship in the capital in play. That's the idea of capital leverage and scale. But there's a subset of that. And one of the things that we realized when we started putting together the idea behind the 5K Income Challenge was this concentration of capital in fewer positions, which led to higher profitability. And by putting more money into a single position, we were able to generate more on the profit side. I'll show you a table which illustrates that in just a moment. But what we typically see is people doing the reverse. One of the challenges you have as an options trader, depending on your capital base, is you have limitations. These are limitations that wind up built in to your approach. For example, if you have a $50,000 trading account and you want to trade one contract of Apple, well, that's $13,000, whether you're trading a call or a put. And that represents a significant portion of your capital, which limits your ability to generate income from a stock like Apple, right? You can only trade one contract, so you can only get the value of one contract premium. By concentrating capital, and the way we're approaching it here is using a $100,000 portfolio or trading account. By concentrating capital and by scaling the number of contracts, we avoid or overcome that limitation. Part of that too has to do with aggressive trade management, meaning, and most of you who have sold options, you're familiar with rolling, closing early. These are aggressive management tactics. Rolling is a tactic to either continue carrying a trade on, generating income, avoiding assignment, or just extending the life of the trade for more income. Closing early is a way to increase your rate of return on a trade. What we've found is typically on the losing side of a trade is where aggressive trade management can make a significant difference. There may be other conditions attached to this, but I'm not going to go into them because it's not critical right now. Well, the way I want you to think about it is this: if you have a position that is working against you, which is call it lesser evil? Closing that position and redistributing that capital into something that can restore your loss, or carrying that position on and on and on and on and on, and maybe never getting back to break even. By learning how to continually adjust and or reset positions as part of the 5K income challenge, what we have learned is we've found ways to recover faster from drawdowns, from losses. It also has to do with the tactics we're using and the scalability of those tactics. We're also willing to take losses, and I think this is the hardest thing for anybody or everybody. It is not easy to tell you to take a loss. It is not easy to look at your screen and say, well, what am I going to do? We've had to take losses in our trading. Excuse me. The second half of last year was what I would call the school of hard knocks. And by learning how to take those losses, we've also learned how to recover from them, how to build tactics that can restore our profitability and keep us moving in the right direction. The final point and the final factor has to do with capital allocation. And this one is a little bit unusual. It may be a little unusual. When we start with a $100,000 portfolio or trading account in the 5K income challenge, we are always trading based on that $100,000, irrespective of profits on the account. If we have losses or if we draw down below, then we'll adjust our position sizes accordingly. But the key idea here is we don't want to put, as much as possible, we don't want to put profits at risk. We will, because we have a willingness to take losses. But this idea of trading the same base capital means we are protecting profits, and we allow ourselves essentially the ability to reset our portfolio on a quarterly basis. So we can take that money off the table, any money that we've made, take it off the table and kind of start fresh. Because this approach in the 5K income challenge has significantly higher rates of return, as you will see in the slides ahead, you can do that with more confidence. You can take that money off the table. You do not have to keep, I mean, there's a natural limitation, I think, to scale, for example. I don't know how many of you have ever traded 100 contracts. I know I haven't, but you also don't need to. The maximum number of contracts we've traded inside the 5K challenge is 20. So we don't have to go beyond that. And we don't need to continue to scale up a portfolio beyond that $100,000 if, based on the rates of return we've generated over time, we can continue that process. If we keep getting those kinds of returns, as you'll see, then the numbers will work themselves out in our favor. To give you an illustration and a point of comparison as it relates to scale and leverage, I wanted to take a look at a comparison of single-sided put option and a trade we recently closed in the 5K income challenge. Now, take this with a grain of salt. These are individual trade examples. Numbers, premiums, et cetera, will obviously change on a weekly basis. I'll show you a different way to look at this at the end of this comparison. But this is the left side, excuse me, is two put trades. These were selling puts at a 155 and at a 103 strike. Total income, $70.47 respectively. One contract per trade. So you have two total trades, one contract for each of them. Total capital of $25,800. Cash secured, however your margin, however you're trading. Total income, $117. The time of these trades estimated at 3 days. So maximum weekly income here would be $117, right? That's the option seller. Most of you are selling options. You're familiar with that kind of a process. For aggressive growth, here's a different approach. This is a trade that we closed recently on January 6th, just last week. I think it was last week. These years go by so fast, who can keep track? A trade we closed on January 6th. This was a calendar spread. The capital requirement was $540 per spread. We traded a total of 20 contracts, so $10,800 in capital used. The total income from this trade was $1,800. This trade took just under 30 days to complete, which means if I take that $1,800, divide it by 4, that's the equivalent of $450 in weekly income. It doesn't work out that way because you get the money, obviously, at the close of the trade, but I'm looking at this from a weekly comparison to start. So if we put those two side by side, this is what we get. On the left side, we have the put seller with two positions using $25,800 in capital, or assuming a $100,000 account, 25 to 26% of their total capital with one contract per trade. That income represents a 0.5% return on capital, which is fine. There's nothing wrong with that, not on a weekly basis. On an annualized basis, that's a 26% return. If you are maximizing a $100,000 portfolio at those rates of return, you're going to do just fine. You're going to generate plenty of income. If you need to be more aggressive, or if you want to be more aggressive, the right side of this table shows you where you want to live. 50% less capital, 60% less capital. Outstanding total income on this one trade. And again, grain of salt, it's one trade. But the difference here comes down to the return on capital and the annualized rate of return. This one trade was 16 points with a 16.7% return on capital. Remember, it took 30 days to complete. Over a 12-month period, if you replicate something like this, that's a 200% annualized return. So you would effectively triple a position at that rate of return. These are the types of trades, these are the types of tactics, and this is the scale and leverage that we are using inside of the 5K income challenge. This is our objective. Now, every trade isn't going to be $1,800. It doesn't have to be. It's targeting trades at scale that generate higher rates of return on capital, which annualized wind up being 100, 200, even 400%. You're not always going to get them, but that's the goal. That's the target, because that's where you get the aggressive growth by trading options. And they are spread trades, so they are a little more, there are a few extra steps. But if you know how to sell a put, sell a call, buy a put, or buy a call, you can make any of the trades that we're making. It is the construction of any of the tactic that is different. That's the only thing that changes from selling a single-sided option. But again, I will stress, single-sided options, 26% return, nothing wrong with that. If you want to be more aggressive or find a way to be more aggressive, this is a path that you can take. And this is something that we've been working on for over 2.5 years now. And I want to share with you the impact of scale across 4 real money portfolio tests. Going back to 2020, when we first started down this path, We traded a $3,500 baby account. And in a short period of time, 6 months, we nearly doubled that account, 93% return. We took that account from $3,500 to $6,700. On an annualized basis, if we had maintained that pace through the next 6 months, that would have been a 187% return. We then took a $10,000 account, applied the same principles, in 17 weeks, generated a 67% return. These trades, these returns, everything I'm showing you here is inclusive of successful and unsuccessful trades. So they're net results. That 67% annualized would have equated to a little over 200% on an annualized basis. So then we traded a $50,000 portfolio and doubled that portfolio in 10 months. On an annualized basis, that's a lower rate of return, 126%. I say lower, I don't mean that to be facetious. I just mean compared to the other tests we had been running. And then we took a $100,000 portfolio and grew that to $200,000 in 27 weeks. That's a 103% return or 227% annualized. All of these accounts, all of these trades have been handled through our small account trader workshops or our small account trader service. And even for the final one in the 5K income challenge. I'll cover those details, some of the details on the returns in just a couple of minutes. First, I want to walk through some case study background on the 5K income challenge to put some context around the numbers. And to do that, I wanted to begin with the genesis of the 5K income challenge idea. So those three portfolios at 3,500, 10,000, and 50,000 that I was showing you, we were largely trading a small set of tickers, and we were trading them consistently. And what we found at those lower portfolio levels was that we were generating average, consistent weekly income. Again, as I pointed out earlier, it wasn't necessarily every single week, but trades averaged out over a period of time were ranging from $113 to $229 a week in income at one contract per trade. So when we sat down with Chris and Dave and thought this through, that's almost $1,000 a week averaged out over the course of a year. If we scaled that up just to 5 contracts per position, that's almost $5,000 a week, right? That's how we got to the goal. That's how we came up with the idea of how do we get to this idea of $5,000 a week. It started from what we were already doing at very small portfolio levels, then using leverage and scale to grow more aggressively or to be more aggressive in our income collection. From there, we had to make some general assumptions, which we've now put into play in real money and have actual results to help us with these assumptions now. We started with a $100,000 trading account. This was real money. In fact, we had 2 separate accounts. Dave had one and Chris had one. We wanted to keep our capital in a little bit of a divided state, meaning we wanted to maintain roughly 80 to 90,000 in active capital in trades on a consistent basis, and then keep $10,000 to $20,000 in reserve that could be used for adjustments if we wanted to add a leg to a trade, if we needed to roll a trade, but we needed capital on hand for margin purposes, right? That $20,000 up to $20,000 in reserve was designed to help us get through periods where we needed to tap into our own funds without borrowing from the broker. We also wanted to maintain a smaller number of positions, as I mentioned at the outset, concentration of capital in fewer positions. So we've only maintained an average of about 5 to 7 positions. We're actually closer to 4 to 5 positions now because of market conditions. We're trying to keep ourselves as insulated as we can while still being aggressive in the income we attempt to generate. This meant that we would have capital per position of $8,000 to $20,000, depending on the ticker or the stock or ETF traded, and a range of capital per contract anywhere from $500 to $3,000, and contracts per position of 2 to 20. Right. So this was just the genesis, the starting point for how do we get this into action, and what are our capital allocation tactics. And how do we make this a reality? From there, we went into some more to developing more basics in terms of the strategy's approach, the approach of the strategy, excuse me. The number one thing we knew we needed to do is to trade very liquid tickers. Because we would be trading anywhere from, on average, 10 to 20 contracts on a trade, we needed to be able to have those trades execute. So we have largely focused on a small group of sector-based ETFs and some of the most widely traded stocks. There is a longer list to this, but I felt that you would get more than enough of a flavor from this by seeing SPY or SPX, the Russell or the IWM, both on the Russell, XBI, SMH is a semiconductor index, ETF, excuse me, the Qs, the diamonds, etc. So very liquid, very heavily traded, so easy to get our trades executed. Now, we may not necessarily get exactly the price we asked for in premium, but we have a far better chance of having our trades executed because of the liquidity behind these ETFs. On directional bias, we have shifted, and this is a lesson learned from the last 12 months, and I'll take a moment to explain this. Our original premise was to be neutral bias, meaning not trying to trade directionally bullish or bearish. Last year, middle of the year, changed that. We needed to be directionally biased because the market was directionally biased, and there was the only way to trade that market was to shift from neutral to bearish, which we did. Now we're shifting back between bearish and bullish, depending on what we're trading. So we have incorporated a wider set of directional bias to the tactics and the trades that we are executing. That is to the benefit. It was initially to being neutral in June was a bad idea. Let's put it that way. But we're largely trading spread options that have a long option, 30 to 120 days to expiration, and a short option that may be anywhere from 5 to 10 days to expiration. We've largely been trading calendars or diagonals. Again, not complicated to put together once you get the hang of them. But we've been trading them as a net debit. So in other words, paying to enter the trade, then exiting with a significantly larger credit than what we paid. We still do some credit-based trades inside of the 5K challenge. But what we found is that aggressive return has come, the best aggressive returns have come from the net debit side of these types of trades. We do open and close trades frequently. This is a very active approach to income generation, and we manage our positions on a very, very regular basis so that we can take advantage of what the market gives us or get out of the way of the worst of the market when or if it happens. So to that point, I showed you in the table just a few slides ago, the 4 trading accounts that we had traded. The 4th one was our 5K income challenge account. In 7 months from November of 2021 through the beginning of June of 2022, we doubled our portfolio. So the first thing that we wanted to take away from this chart was that it worked. It worked. We were absolutely killing the market, and that's a 100% return on capital in 7 months. So the premise behind the 5K income challenge was validated. And then the rest of the year happened, and we will not be shy about it. It was hard, and it was absolutely fast moving to the downside. This is the point where we had to shift our tactics dramatically from, as I said, from neutral to bearish, and then back to bullish, and then back to bearish. So we had to make rapid changes. We did take significant losses in the June and September periods. We ended the first year trading with an overall 31% gain. So we did give back profits because of the market late last year. I don't want you to, two things. I don't want that to dissuade you, but I want you to be realistic about what happened in the middle of the year last year when the market rolled off the shelf in June. The success that we had early on was due to our calendars and diagonals generating significant profits. In the summer, rapid swings to the downside put us on the wrong side of longer dated options. which led to us having to close more trades at losses. So we have changed a little bit of our approach because the market changed. Market will change again, and we'll continue to adapt as the market does. But out of all of that, the obligatory phoenix rising from the ashes are two new tactics we've developed, which are specifically intended to combat volatile swings in the marketplace. And I'm going to walk you through the performance of these tactics, not necessarily the construction, or we'd be here all day. But the two tactics are what we call the Dragonfly, which we use on the SPX, and the Boxcar, which we trade on the RUT, R-U-T, or Russell. So let's take a look at the performance of these, and you'll notice that we started trading these at the end of September. This is at the end of the second drawdown that we suffered last year. This is the SPX Dragonfly, and you can see the profits from the trades in the table. We'd largely been trading around 5 contracts. We're starting to push that up a little higher to 10. We just closed the trade this week at 10 contracts profitably. The key here is the average time in trade, which is 4.4 days. One of the ways you combat a fast-moving market is the speed of your trade. If you're selling weekly options, for example, and you have 3 days to expiration, that's a speed of trade function, meaning you have more ability to still capture the premium in that trade because you have fewer days in the market. So this is one of the reasons we built out these two little tactics, so that we could still deploy a concentration of capital in a position, still capitalize on the motion or movement in the price action of the underlying ETF, stock, sector ETF, et cetera, but have the potential to generate more consistent income without the issues we struggled with on the calendar side of the trading events. This particular tactic in 11 trades has generated total income a little over $4,400. Average per week across that period of time winds up being $834. So given the number of trades, the number of times we traded it, we're now beginning to trade this more frequently, almost on a weekly basis. We put these trades on Friday. We tend to close them the next week. And we will continue to use this tactic because it continues to work. This is an example of what we're doing inside of 5K that is different from most other services, where the tactics may be static, which is okay. There's nothing wrong with that. But when the market moves dramatically or changes, we all have to have ways to change with it. Thus, these new tactics. This is the RUT, the Boxcar trade. Don't let the names. We made the names up. We'll be brutally honest about that. A boxcar is nothing more than a series of credit spreads linked together. That's all it is. Just think of a train and call it an income train, right? Each boxcar represents income that's preferably moving down the tracks toward you. Again, we've been trading between 5 and 10 contracts. We started out on the high side. We've pulled back from that a little bit over the last several, from November and into December. Total income generated using this tactic, $9,356. Averaged per week across the period of time, that's about $1,100 per week. And the average time in trade, again, very short at 6.4 days. So you can see our way to combat the market was to keep our money in the market for less time, not more time, and to extract profits as regularly and as consistently as we could. At the outset, when I talked about the genesis of the 5K Income Challenge, I shared with you this table. And I want to take a moment and focus on one ETF, the XBI. This is from the email sequence that we sent to have you register. We talked about the one ticker that had generated close to $30,000 or generated $30,000 in income for us. This is that ticker. So note here the consistency in the numbers from our projection when we first set out to begin the 5K Income Challenge. At 5 contracts, it was $565. Watch the consistency in this. So I'm going to take you through a few parts on this slide here. Up in the top right, you can see a chart of the XBI from July of last year. I keep forgetting it's a new year. through the early part here of 2023. You can see a very strong channel has developed since October with a sideways movement in the XBI. We've been able to trade around that consistently and frequently. The table at the bottom right is the income per month. So you can see we've had significant income in some months. We've had very little income in some months. The lesser income is due to not trading the XBI during certain periods. So for example, July of last year, we only put on one trade. I think it was 356, or I may be dyslexic, it may have been 365, but it was just over $300. So not a huge trade. But you can see August, September, October, November, December, we're consistently generating pretty close to $1,500 on average from this one position. And some of the elements to the tactic from the scaling part that are important. We're trading 20 contracts per trade, generally around $10,000 in capital used on this trade. It may be a little higher, it may be a little lower, but use that as the base. That on a $100,000 trading account represents 10% of our portfolio, just as I showed you a little earlier in the side-by-side comparison with the puts, with the put seller. We're using calendar spreads. This is the XBI is the trade that I used earlier, which had generated the $1,800 in profits. And on a per contract basis, it's roughly $500. Again, maybe a little more, maybe a little less. But the most important factor for us here is that we are using the same capital on successive trades. What I mean by that is we close one trade before we open the next, which allows us to use the same $10,000 throughout the year. For 2022, across the full year, we generated income of $29,736 from the XBI, one ticker, nearly $30,000 in income. That's a 197% annualized return. That's based on using $10,000 per trade, at the same $10,000 per trade. And I told you to watch for the consistency here. The average per week, $572. So what I showed you here was 565. That was simply a projection based on 5xing $113. And now we are actually very consistent with that number. But what's different is we made 22 total trades on the XBI last year. So this average per week of $572 is actually higher, would actually be higher because we didn't trade it 52 weeks. So that 565 here is based on 52 weeks. Our actual average here is based on 22 weeks. So there's more profitability in this one particular ticker and tactic, and with the scale behind it, then I actually can show you, because I try to annualize all my numbers, and sometimes I do that to our detriment. But you can see by the table of income how consistently this has performed. Some months have been above 3,500, 3 of them. Most months are around that 1,750 line, which is phenomenal, right? That's a 17.5% return on capital every 30 days. You are going to be substantially in the black at that kind of a rate. These are the types of trades that we're looking for. So across those 3 tactics or tickers that I've shared with you, the SPX, the RUT, and the XBI, we've used $10,000 to $10,800 in capital per trade. We're averaging roughly 834, 1169, and 572 in weekly income. That's $2,575. Again, this is on a weekly average, which represents an 8.3% return on capital traded. Now, if I compare that once again to selling puts, and I'm not denigrating selling puts, it is a viable strategy for folks who have less time, who need more of a simple approach to generating income. Selling puts is still your best bet. For people who want to be more aggressive with their capital, this is the table that helps you understand how and why you want to be more aggressive. With essentially the same capital, 30,000 versus 25,000, we are generating 8 times the income on a percentage basis, excuse me. 8 times the income on a percentage basis. Actually, 16 times. My bad. 5.5 times 16 would be 8. That's an annualized return or rate of return of 430%. That's not going to happen all year long, but as a goal, as something to aim for, this is why we were able to take that portfolio from 100 to 200,000 before last summer happened. That total income, 2,500 versus 117, but using essentially the same percentage value of your account. That's the aggression. That's the scale. That's the leverage and the tactics. So the first 7 months of, as I mentioned before, of the 5K income challenge really proved that it can be done. The key, the School of Hard Knocks that we enjoyed attending, summer school of Hard Knocks, it comes down to defending drawdowns. That is where we've made the most improvements in our approach and where we have taken the most action on our trades to get out of the way of a fast moving market. Sometimes it's not possible. One of the things I'll point out to you on the table that you're looking at here is what would be effectively the January period. Excuse me. So on the left-hand side of the chart, you can see a 2-leg drawdown. So that is consistent with when the market went off first started selling off rapidly in January of last year. And we had, I think, between $10,000 and $20,000 in drawdowns across those 2 weeks. That would be about right. You can see that will happen, but what you also see is how rapidly this approach can recover. That aggression can work for you and against you. It's making it work for you far more frequently than when it works against you. That was what I mean by defending drawdowns. The new tactics that we developed in the Dragonfly and in the Boxcar have helped us and are helping us and will continue to help us this year. But what we find is over time, the volatility of these returns will smooth themselves out. In a really compressed space of time, they won't, right? If you lose money in a 1 month period, it doesn't matter what your equity curve looked like beforehand, it's going to look ugly for a month. But over time, just like if you take a long-term view of the Dow or the S&P, right? Even the 2008, 2009 market collapse smooths out if you're looking at a 50-year chart. That's probably spin, let's be honest, but that's what happens over time. This is not a very short-term kind of strategy. This is an approach where you have to have a willingness to trade this actively, to have your money in the market consistently, to not be afraid, actually to be afraid of missing moves. That's, it's the old maxim that, the people who never make money are the ones who always miss out on the biggest moves of the day because they took their money out when the market went down. This is kind of the same approach. We want to be in the market. We want to be fully capitalized as often as possible. We can still control our position sizes. If we have a less than stable market, we can pull our position sizes in and then expand them when markets are more stable, when price action is more stable. But our objective is still a 100 to 200% growth rate. We had 100% growth rate for a period of time last year. We did give back. We ended the year up 31%. To that end, the goal is still to average that $3,000 to $5,000 per week net income, trading a $100,000 portfolio or trading account. Actually, I wanted to go back to this slide. And what you can see is based on the three tickers that I've shown you, the way that we're trading them right now, the averages that they're pulling in, we're already halfway there. So it doesn't take much for 2 more positions or 2 additional positions to get us to that $4,000 to $5,000 range. And even if it's $4,000 a week, that's still a significant increase in income on an annualized basis. So we will be opening up the 5K income challenge. We will take questions here in just a couple of minutes. I have Dave along to answer the questions that you folks may have. This approach, this aggressive growth approach, is for you. if you're an experienced options trader. I want to be brutally honest. If you are new to options, this isn't the right place for you to start. If you are self-sufficient, know how to execute trades, if you know the difference between sell to open and buy to close, for example, you can do this. If you are able to handle the short-term swings in portfolio value, similar to this chart that I showed you here, if you can handle those and know that you're going to get the upswing still, and if you can start with $100,000 or fairly close to it, and want this kind of rapid account growth, then we are going to be opening up today to people to join this exclusive little group of traders. We have about 44 traders in the 5K Income Challenge right now. We are opening up 25 new seats tonight in a different way. So bear with me, and then I will do all of the questions for folks. What's different about the 5K Income Challenge is we don't do live trading. We don't hold trading webinars. Because Dave and Chris are constantly monitoring the trades and the markets and the tickers and the tactics, we are instantaneous and real-time trade alert based. So as soon as they have a trade that they want to make, we send that out to members of the 5K Income Challenge. They will get, on the trade recommendation side, you will get anywhere from 5 to 7 trades per week on average. Sometimes it's more in a busier week. Sometimes it's less in a quieter week. But the core of this is trading. So as I mentioned here, if you can be self-sufficient, if you're experienced, then you will be able to make all of these trades. We give you the entirety of the execution that's needed for you to make it. Everything from whether you're buying or selling, what you're selling, a put or a call, the expiration, the strikes, and the anticipated or expected premium for the underlying stock. So you get all of the details in our trade alerts. And we also do a weekly briefing that's a text email-based briefing, so we can keep you up to date on what's happening on individual positions, price action, or other things happening in the market that we see. We released last year an app, and all of our alerts are sent through that app. They're also posted to our members' website and to a new addition to the 5K Income Challenge, our social trading hub, which is something we've developed to allow members to be able to interact with other members, to help each other, to share stories, share successes. Who knows, maybe somebody will get married off the social trading hub. That would really be kind of neat. Anyway, we also hold a monthly review webinar with members. So each month we have a chance to review the performance, excuse me, the individual trades and tactics that we are using. There's a members website. We have training materials around the various tactics that we're trading. So there's plenty of learning tools available to you if you're not 100% confident in how you're constructing a trade. The help is necessary. Help is available to you if you need it. And there's also email support direct. Chris and Dave will alternate answering questions by email, so you're never left on your own. If you need help, if you want help, it's always there for you. We'll be starting the next phase of the 5K Income Challenge. This is now the last phase, meaning we're opening this up to a small group of people here in January. Our first trades for the next group will be January 20th. That's a Friday. The day before, January 19th, we will be holding an onboarding and welcome session. A little bit about that. That is so that Dave and Chris can make sure that you are prepared for the tactics they'll be trading. They will walk you through the construction of the types of trades they make. They will familiarize you with the tickers they anticipate trading, although I've given you many of them here. You already know 3, the SPX, the RUT, and the XPI, but they'll show you how to construct the trades. Dave and Chris will assist you to understand capital management, how to put your money in and take your money out. They will walk you through the way that they construct trades and the alerts. You'll get, so you'll know how to read and execute the alerts. One of the things that we do in our alerts, which I don't have a way to show you today because I'm not on my mobile phone, is we tell you in the alert the number of contracts we are trading in our master portfolios. So you always have a guide on the capital side, on the scale side, of how many contracts are being traded per trade, for each trade. And all of our alerts will carry you all the way through the trade, from open of the trade, any adjustments or resetting of the trade, to the closing of the trade. I will also walk you through using the hub so that you can all connect with one another if you choose to join the 5K Income Challenge, and the members website, so you know where to find what you need anytime you need it. A recommendation from experience of other traders who are part of the 5K Income Challenge. We suggest, because we can't demand it, we suggest setting up a separate trading account. You may have to do this over time, but we suggest finding a way to set up a separate $100,000 trading account for the 5K Income Challenge. There are two reasons for that. The first is so that you know what your absolute returns are on the 5K Income Challenge. The second is to protect your trades from any other trading you're doing, and vice versa. So we've had, and I think it was Interactive Brokers, which has taken negative or adverse actions that we couldn't even explain against individuals in the 5K Income Challenge, whereas we don't see those things happening with Thinkorswim, Tastyworks, E-Trade, or Fidelity. So it may be a broker problem, but we strongly recommend setting up a separate account, whether it's an IRA or a trading account is up to you. Everything that we're doing in here can be done in an IRA. You do need to request from your broker. Their level will differ, but level 4 to level 6 options permissions. You simply tell the customer service person you talk to, who will have no idea what you're talking about, that you need options permission for spreads, margin indexes, cash secured puts, and ratios. You can write that down if you want. I'll leave this up for a few seconds. You need that permission in order to make trades on some of the index ETFs that we trade, and the types of tactics we're using on those index ETFs. That option permission essentially is like, it's the equivalent of a platinum card for options traders, if you will. So remember, that is a requirement for when you join. It's a requirement for you. I can't make it a requirement to join. Sorry, I misstated that. You need that permission in order to execute some of the trades that we are making. And that's what allows you to do any of this inside of an IRA. If you're a Canadian account, different rules, different issues. I think actually we have a video that can help Canadian traders overcome some of the hurdles that you face as a Canadian trader. We deeply apologize and sympathize. This month, we're doing something different, and we're opening 25 seats, but we are also opening this as a 90-day trial. What's different here is this is a hard 90-day trial. There's no recurring charge. There's no commitment beyond the 90-day period. So you start on January 20th, and you will end on April 20th with the 90-day trial. The trial fee is $9.95, so it is a paid trial. But when that trial period ends, you will then have an invitation to join with an annual membership. This gives you 90 days to see how close just these 3 positions can come to that $2,500 expected income, for example. But we are opening up for a small group of people this year. Because of the volume of trades, we are metering the number of people we let into the program on a fairly regular basis. So this was a new way we wanted to make the 5K Income Challenge available for people to try it, to see if it works for you. Don't be afraid to scale in slowly. We may trade 10 contracts. Feel free to trade 2 or 5 and learn your way up with us, even over 90 days. I mean, frankly, one of these trades would effectively pay for your 90-day trial in the first week of trading. But again, we're not starting until January 20th with trading for the new group. So that gives us a week to get everybody on board. That gives you a week to get yourself set up and ready to go. And then we'll kick off on January 20th. We're going to send everybody to this page. So Suzanne will be putting a link in the chat box for you. For those of you who have been waiting for 5K to open back up and want that annual membership, you can still get the annual membership from this page. That's the orange button at the bottom. And that does come with a $1,000 discount today. If you want to test this, if you want to try this, you could take the 90-day trial for $9.95, use the green button. But most importantly, please watch the 7-minute video on that page. I will be replacing that later tonight with the replay from this webinar, and I will add this 7-minute video a little lower on the page for you. But watch that 7-minute video. That is the introduction to onboarding that you can expect. I told you that onboarding would take place on January 19th. I believe we have that set for 5 p.m. You'll be automatically registered to the onboarding webinar with Dave and Chris, so they can take you through and set you up for success. That is the purpose of the onboarding and welcome webinar. So again, that will take place on January 19th at 5 p.m. That's a Thursday. But this little video, I incorporated it mainly as a placeholder, but after listening to it, I realized this is a really good way for you to get a sense of how they're going to help you learn or understand everything that they're doing inside of the 5K Income Challenge. And they do it in 7 minutes, which is a lot less time than I took today. So again, you can choose the green button for the $9.95 90-day trial, no recurring charge. There's no continuation added to that. Once the 90 days is up, if it wasn't right for you, you're done and you're out, no additional costs. If after the 90 days, you find out that you really like making a lot of money, then you can move to an annual membership from there. Note that moving to an annual membership would be a full 12-month membership, not an additional 9 months membership. So you would be a full annual member at that time. So again, 90-day trial, not a recurring charge. It's a one-time fee, no commitment beyond the 90 days. You get access to everything. So you get all of the trade recommendations. You get access to the app, the alerts on the app, the members website, the social trading hub, the monthly review sessions for the next 3 months. Yes, there'd be 3 review sessions in there. So you get access to everything. Nothing is withheld from you during the 90-day trial or just because you're in a trial period. So with that, let me
John, I'm sorry, I'm having trouble posting the link to everyone. I only have host and panelist permission. Maybe you can get the link out. Sorry about that. Or change my permission. I see you did that. Thank you.
hang on a second.
I just did it. I think you can do it now in the chat box.
We'll just do it again. Just keep doing it. Everybody, I don't know why.
Perfect. That worked, Dave. Thanks.
Panelists can chat with everyone. Somehow they got reset to no one. That's strange.
No, I changed it back to the everyone. It was set on no one at the start.
Okay, so there we go. So Dave, as long as you're here,
Yep.
Timothy, for the 5K Income Challenge. Actually, hang on. Let me pull my screen back up.
Yeah, I think you showed all the trades for the last 6-12 months. So
Yeah,
we
let me
already
share and play, and your screen sharing is paused. Why? Let me try again. Give me a second. That's an amusing change. Share screen. Something is wrong. I'm wondering if I lost the connection. Hang on a second.
Yeah, I still hear you.
Yeah, no,
Yep.
it's something else. Hang on a second. Let me get back.
Let me answer. While you look at it, and I'll answer a couple of the other questions. John asked, how do you set up those trades? Again, we're options sellers, so we're looking for liquidity in options and volume in options. We definitely want to have, we don't want to be trading something that's very thinly traded, because we're trading with enough people trading 10, 15, 20 contracts sometimes. So that's the first thing we're looking at. That leads us to a lot of the ETFs, whether they're the broader index ETFs or the broader ETFs like the SPY or the Qs, the triple Qs, or actually with the index funds, the SPX or the RUT, which is the small count, Russell 2000. So we look for basically looking for tickers that we can trade with volume. The other tickers we trade, the XBI, the XOP, SMH, they've traded volume no problem. So that's generally how we come down to the tickers. We have traded stocks, but when we trade stocks, they're going to be stocks that have a fair amount of volume and trading liquidity so that we don't get stuck in those trades. You don't want to get into a trade that you can't get out of.
Let
So
me
that's
drop this question really quickly. Can you discuss the response time requirements to execute the new tactics trades? You mean, Kyle, I assume you mean how fast do you need to be able, do you need to be able to respond to a trade alert? I assume that's what you mean by a question, Dave, what he means by the question, if you want to take that.
Yeah, I mean, it can be done in 5 minutes. I mean, I've traded both on my computer, on an iPad, and on my phone, an app. We have a combination. I've traded this on Thinkorswim, as well as tested it on Fidelity. Primarily, our master account is on Thinkorswim, so they have easy ways to trade that. And I've also tested on Fidelity. Chris trades it on Tastyworks, and we have a lot of customers we have customers that have interactive brokers and E-Trade. So
when the alerts come out, though, I think the question is geared more toward the time sensitivity of execution.
Oh, yeah, we recommend you try to trade them within an hour, but really within that day. I mean, there are exceptions because the Dragonfly, we open the Dragonfly every Friday. We don't put that on any day. We open that on Friday and sometimes close that on Monday or Tuesday. We're looking for theta decay almost as soon as that happens on Friday. So we'll put that out around 11 to noon or even 1 o'clock on Friday. So it's good if you can get in there before 1, 2. But the other trades, if you're in within an hour or 2 hours or even within that day, that's fine.
Okay, give me just a second to come back down to here. I think it was Christopher about the discount. The $49.95 is the discounted rate. I apologize. The regular rate that is $59.95. We're applying a $1,000 discount for annual members during this webinar, well, this event, the sign up event. So the $49.95 is the discounted amount. My apologies for not making that clear to you and for the frustration on that. Excuse me. Do we ask questions about? We do not do auto trading. KP, thanks for the question. I appreciate that. This is a system. This is an approach that really because of the volume of the capital and the contracts, individuals have to have the control of execution. We may trade the SPX and you look at it and say, you guys are nuts. I'm not taking that trade, right? That could happen. That's why we prefer not to auto trade our services or anything related to the 5K income challenge. So I prefer you have total control over what trades. Greg asks, Dave, this for you, do you use bull put, bear call, or iron condors?
We've used all of the above. We primarily trading calendar and diagonal trades, spread trades, and they can be anywhere from starting with one, adding a second calendar on, or adding a third. We've gone out to 3 wide on our calendars. Again, we're trying to cover those calendar diagonals tend to be neutral trades so that we can manage with the market as it's trading around. But that's different than the Dragonfly and the Boxcar. The Dragonfly is really a butterfly trade, and the Boxcar is a combination of a debit and a credit spread. So that's like a bear call spread and a bull put spread. So yes, we can use a combination of those credit spreads as well.
Do you also defend, repair, or adjust losing trades?
All the time. Okay, so yes, we adjust trades when they're 2 times we adjust trades when they're moving in our favor, and we can actually pull out. I think we can pull out more profit. We will adjust the trade to the upside, and we do that with our Dragonfly to add profit to the trade already existing. We can do that with some of the calendar diagonal trades, depending on how fast they move. To the downside, we do the same thing because we obviously want to. While we can't get out of every trade with a profit, we're not going to hit 100%. We do want to minimize if we're going to have a losing trade and it's moved against us. We want to minimize that loss. And so we do make adjustments to protect us heading to the downside. We don't try to stay in trades, particularly in this service, very long to try to draw out to go to a finish, that we can get to a profit. It would not be worth it for us in this service to try to work a trade for 3 months just to break even. We do that. We teach that some days in our other small account trader, but not here in 5K. We'll take the loss and move on because we have better ways to deploy our capital.
John is forcing me to give away secrets. So John Grimm, I'm going to tell you right now that the folks who do the trial will still get the discounted rate offered to them in April. But the price will be going up for other people in the April and to June time period. So the discount would actually wind up being a little bit bigger. So that's a little future casting for you there. Let's see, this is becoming, oh, Christopher, thank you. Welcome to the 5K Income Challenge. Thanks very much. The chat box is becoming the Greg Moore chat box. So give me just a minute, Greg, to answer some other folks' questions. If you don't mind, stick around and I will get back to yours. Timothy, we had, when I had the slideshow fail here, we had left off with you. And so the table, the chart up at the top here, we were showing over our full portfolio over the full 12 months was up 31%. So it was about $31,000 to $32,000 in total profits across the period from January to December. We had other profits that we had generated in November, December, but not trying to count those. Some of our beta test groups had different experiences from April and July. The July group is essentially at break even. They suffered in September. We recovered in October, November, and they're only 5 months in, so they still have 7 months. I think that portfolio will turn around substantially for them. The other beta test group is 8 months in. They still have 4 months on their test. They were down as much as 18%. We are still working that one back. I think by April, they will be on the positive side. It's not going to be 100% for them. We'll just be honest about that. But I think this year is going to be different than last year. So I would rather, I hate saying it, but I'd rather learn from last year and apply what we've learned, because that gives us more confidence for the year ahead. Thanks for the question, Tim. Appreciate it. I know you're a long time member with us. So good to see you. And thanks for asking the question. Stefan, is assignment of stock ETF an option inside 5K? I don't know that we want to say option, but can you talk briefly about
so first of all, any of the American options we trade on the SPY or QQQ or SMH or XBI, those can be assigned anytime. The index funds, the SPX and the RUT, can only be assigned right at expiration. So, but here's the thing: we have not been assigned. We've only been assigned twice. Once during the test phase in December of 2021. I was assigned the SPY, but Chris wasn't. And then this year in December, we had some DIAs. People were assigned DIA. Some people were assigned QQQ. Some people were assigned both. I was assigned the DIA, but not the QQQ. And we figured that why this has happened in December is we figured this was probably market makers selling up accounts at the end of the year, because they all occurred in that last week and a half at the end of the year here. We actually managed around those, and we actually were able to make profits on the one of those trades, even with the assignment. But the assignments, no, we don't take assignments. We don't. We're in and out of these trades fast enough that we are not letting these things go right up to expiration or getting to the point where we run into that. And plus, because we're trading primarily, not saying we don't trade stocks, individual stocks, but primarily right now ETFs. We don't have to worry about dividend assignments on the quarters.
Charlie, defined experienced trader. Charlie's been around for a while too in most of our services. Dave, what would you say? How would you position or explain the experienced trader for somebody who's traded puts, calls, rolling, etc.?
I would say, if you just sold puts and covered calls and maybe rolled those positions, that's one level. We are trading spreads primarily. Again, you saw John pointing out in the very first presentation, part of the presentation, the leverage you get with the weight, the style we're trading. So using spread trades allow us to leverage and not have to put up, let's say the SPX, which is $300 and some dollars, put up $30,000 per one contract. So we are trading with spreads, and we may have a combination of spreads. We maybe have a combination of a debit spread and a credit spread. We may have 2 debit spreads, and we're working both the long positions and the short positions. So if you're comfortable with that, you'll be comfortable in this. But if spreads intimidate you, or you're concerned about spreads and really don't have a good feel for them yet, that may be a bit challenging because that's all we trade really here.
So apparently everybody's going to the pages because a page is going in and out of working, not working. So stick with it, keep trying. Larry, Lawrence Hand, I think you know Leslie. Feel free, you can always contact Leslie and she'll take care of you, whether you're trying for the trial or the annual. I think Michael just joined. So Michael, thank you, welcome. Let's see here.
I've seen one in here. Several people ask, can you start with $50,000? I will say this, we did not encourage people to do this at the start. I have somebody who's been in contact with me who came in early on, and they've traded with two $50,000 accounts. They started off with one just to get their feet wet, and then they added their second $50,000 account. So they were trading half the number of contracts. We don't necessarily encourage or really recommend it, but we do have somebody who started with 50 and then ramped it up to another 50.
Yeah, the primary, I don't want to say it's not a detriment. The main thing you have to keep in mind is your rates of return will be, not the rates of return, excuse me, your profitability on the trades will obviously be in half or slightly less than half. If we trade 10, you may have to trade 5 or even 4 contracts. Yes, you can do that. And if you're doing it on the 90-day trial, I actually would be okay with a $50,000 portfolio, because then you're mitigating your risk even a little further. But bear in mind that the underlying premise here is designed for a $100,000 portfolio. So our approaches in everything from capital to scale to tactics is built around that. Should not necessarily leave you behind on any trades, because a trade that requires $500 to $2,000 for a single contract, you certainly have the capital or capacity. It's just bear in mind that we didn't build this or create this with the $50,000 portfolio in mind. I think is that the best way to say it for you, Dave? Do you agree?
Yep, exactly.
All right, so I think that took care of all the 50K questions. I have a portfolio margin account with 400K in it. Can I use it to gain portfolio margin advantage? Not sure I know the answer to that.
You can trade with a margin account. We don't. We trade with a cash account and our master portfolio is in an IRA and it's traded as a cash account. Chris does that too. Chris has tested trading with margin, but you really better know what you're doing if you're trading with margin. But you can do it. I mean, because all we're doing is, putting together spreads and entering and executing those spreads trades. So
let's see, a couple of questions on this one. Here's a good one. What is the average percent of the account deployed on the $100,000 total? You're usually 70 to 80% deployed.
Yeah, we'll probably take it a little slower, probably go 50 to 60%. It's on January 20th. And when we start going with this new group, so we generally ramp it up from 50, 60, 70. We've been as high as 85, but generally, because we leave cash available for adjustments. So generally we're targeting 70, 75%. So we can have extra cash available if we need to adjust with that.
Registered for the trial. Raj, thank you very much. Appreciate it. Greg, typical difference between strikes on your spreads. That's going to be a variable, right, Dave?
Yeah. I mean, if we're going in with a calendar, then you're just, there's no option, option margin buying power that you have to worry about with that. You have a debit spread. If you're going with a diagonal, you can't have some option buying power that has to be put into the capital on that. But yeah, I mean, that's
hang on. Tom asks about the TOS Thinkorswim for mobile app. I think you use that, don't you, Dave?
Yes.
Any recommendations on that? Any experience with that?
Not had experience. About less than a month ago, I was traveling away from the area here, and I knew Chris, we had trades coming up, and we both had a roll position and an open and close of a new trade. I pulled over off the freeway onto an exit, got on my mobile app, saw the trades on the phone app, on my Thinkorswim app, and went ahead and made those trades successfully so that I didn't have to miss those. So if you've got Wi-Fi or internet access, you have, whether it's iPad, iPhone, or a Google phone, or even obviously a computer, they work.
Let's see, hang on 1 second. I want to get backward. I'm going backwards. Stefan, Europe cannot trade ETFs and indexes directly, but can sell by options on it. Stefan, that is essentially that is exactly what we're doing. We are using options on sector-based and index-based ETFs. If I remember correctly, you said you're in Munich. So I'll be honest, I don't know the rules around German trading with US stocks, ETFs, et cetera, as it relates to options. Suggestion is and no worse than testing the trial. But I don't know of any other constraints. If you have access to the options market, you should be able to make the trades.
Yeah, the good news about the two indexes, the RUT and the SPX, is, again, they do not assign, they're like European options. They do not assign until expiration date. We never let those go to expiration date. Even though we have short-term expirations on those, a week or 2 weeks out, we never let those go to expiration. So we don't take assignment on the SPX or the RUT.
Yep, just a reminder, let me go back to here. The actual annual rate is $59.95. So that's where the $1,000 discount came in. I made a mistake and didn't put that in correctly, or didn't say that correctly earlier in the webinar. So for those asking on that, that's where the $1,000 discount comes in. My apologies on that. Again, a number of questions from John and Joe in Hawaii, in terms of the time sensitivity of the trades. As Dave said, if you can make the trades, typically the earliest we'll put a trade alert out is 10 a.m. I think I was in Hawaii. What is Hawaii? 6 hours behind us? Is that right?
I believe so. Yep.
Oh, come on, Joe. That's only 4 a.m. Everybody's up at 4 a.m., aren't they? So typically you'll find that most of our trade alerts are coming out between 11 a.m. and 2 p.m. Sometimes a little later if something's going on in the markets. But the time sensitivity question, really, it's as Dave said, if you're able to execute those trades within 1 to 2 hours, you're generally going to be okay. Sometimes you'll get a little bit better premium. Sometimes you may get a little bit of slippage, but the trades are still good. They're still, you can still execute them, even if you don't get them just like that, or execute them just like that.
We have a customer in Hong Kong who I talked to before he joined in the summer, and we gave him a range of times because he's completely opposite of us, and so he stays up through the night. He trades anyway in the U.S. market with other trading ideas, but he makes it work.
John, how late can we be on the trades? So, I mean, you could trade them as late as 3 to 3:30. I mean, or 3:50. It's trying to get as close to an execution as possible. Trading the same day is really the objective. Yes. SAP Pro, Brad, honestly, your question is best put to yourself. This is an entirely different approach from Income Masters. It is an extension of what we're doing in Small Account Trader Pro. If you're happy in those services, I wouldn't take the next step. I think you'll do just fine this year. But a fair question, absolutely fair question. I know we're having issues with the website. Unfortunately, I can't look into that right now, but we will fix it. We will send an email out at 8 p.m. tonight with the replay video. So we will have a way to make sure that we get the pages operating for those who are having issues. Linda, appreciate your patience, and everyone else. Don't forget, you can always contact Leslie in support. Just tell her to take care of you. She's always happy to do that. Which I think Suzanne shared the support phone number and email. So if you're refreshing or if something isn't working correctly, just let her know and she'll take care of that for you. Joe, good question here, Dave. He's an annual and small account trader is 5K redundant.
No. I mean, we are in trading, first of all, different strategies in SAP Pro, and really small 5K is really for the more aggressive part of your portfolio. We're small account trader pro. We're trying to pick up singles and doubles. We're not trying to necessarily hit the triples and knock the ball out of the park. We are taking a much more aggressive approach in 5K, and we purposely have made it that way because that's what it evolved out of. This trading strategies we were using in small account trader pro. We've borrowed some of those. We've actually enhanced some of those with some of the two trading, like the Dragonfly and the Boxcar that John mentioned. So really, one is more of a broader portfolio approach where you're hammering out, you want to hammer out trade wins and build cash each month. 5K is really trying to be aggressive with part of your portfolio with this kind of strategies and fewer tickers as well.
All right, looks like most folks are getting through now. We'll double check with folks if anybody didn't get in, but I appreciate everybody's patience on that. Trade suggestions, same for the trial group and the regular group. Yes, you are, even though you're on a 90-day trial, you're a full member. You get this, you're getting everything at the same time, all the same recommendations, access to all of the same materials, the app, the website, the social trading group, everything. You're getting access to everything for that 90-day period. Nothing is different for you just because you're on that 90-day trial. But thanks, Raj. It's a great question. Appreciate that. What is the last day to join this will be Monday, whatever Monday is. Monday is the 16th. I think our deadline will be Monday the 16th or the 25 people, whichever kind of happens first. Yes, we'll send, what we'll be doing is we'll fix the one page and send everybody back to that replay page, but we'll fix the link that's not functioning correctly. We'll figure out why that's happening. Some folks are getting in, some folks are not. But we'll resolve that here shortly here. Do you stall or delay positions based on Fed meetings, CPI announcements, etc.?
Funny you say that. We used to not to, but as of this year, yes, we do. I mean, for example, we closed our Boxcar trade yesterday for this week and decided not to open until after we see what the CPI results are tomorrow. Now we open the SPX, the Dragonfly, every Friday, so that's sort of irrelevant. We'll trade that every Friday, but we will close that trade before event driven, whether it's the Fed meeting or things like that. It used not to be a big factor in 2021 and 2020. It's been obviously a much bigger factor in 2022 and heading into 23.
Let me knock out a couple of quickies. For XBI, you're typically running 28 days to expiration. Is that right?
No, well, it's any trade. We can close a trade in a week if we make the amount of money.
When you're just closed. When you're setting them up, you're typically setting XBI up on about a 20.
Well, the short options could be out a week or two. The short options are a week or two, and we're generally going 60 days out on the long options. So if we do a calendar spread where we're buying a strike and buying a put and buying a call, or buying a put, selling a put. The bought put would be, right now we're working on February and March long options, and then we're selling the January 20th short option, or maybe the 27th. So when we're trading that kind of the calendar type of trade, we're going out there. The Boxcar and Dragonfly are much shorter. They're usually 10 to 14 day expirations, but we're out of those trades
4 to 6 days.
4 to 6 days.
So Greg, the answer to your question on average days in trade is it's a variable depending on what we're trading and the tactic that we are using. So we can have trades where we can be in the market as little as from 1 day to the next. We may have other trades which have slightly longer expirations. So it's a variable. It's not a singular tactic that we are using here. We are using multiple tactics. And I think that goes back to the question of Tom. That's one of the main differences between this and SAP Pro. SAP Pro, Small Account Trader Pro, is the objective is to generate $2,500 a month on a $50,000 trading account. So still an aggressive amount, smaller, but it's still aggressive. Yeah, but some of the tactics are different. The tickers are different. and the pace of trading is different. Those are the primary differences. So another question here about how many times a week do you trade? From Alex, we can put out trade alerts any day of the week, Monday through Friday, between 10 a.m. and 3 p.m. Eastern. And based on what's happening in the market, our primary trading day for new trades tends to be Fridays. That is the day where we will typically put on the largest number of new trades. And then in the days that follow, Monday, Tuesday, Wednesday, Thursday, we will typically adjust, reset, close trades, or roll trades, whatever action is required on those open trades. So that is typically the flow. We do open new trades from time to time during the week, but most of the time, those new trades are opened up on Fridays. I think so. We will get. I think that's pretty much everything that we have here. I appreciate everybody joining us. Thank you for that.
Yes.
Give me 1 second to stop the recording.